Okay, so we'll just recap on today. Today is Tuesday, the 3rd of May. Again, we're focusing on the Euro-US dollar. So today, Tuesday, the 3rd of May, we can see there are no reports of high importance due out today that will be affecting the Euro-US dollar. But we had the report at 10, the producer price index that came out at 10, but that was of medium importance, and we have another report of medium importance coming out at 3. So the reports of medium importance, which won't stop us from trading, but we'll just be aware to look at the charts at this time to see if they have an impact on the market. So with that in mind, we went to trade, and we started at 6:40. So we saw at the time that the market was trending sideways between the pivot point and the first support. So we placed a pending order just above the pivot point and a pending sell order just below the first support. The market took the buy order at 6:40 on the dot. Went up a bit, came back down, started to go up again, but came straight back down and took us out with a loss of 20 points. So once we had a, once we lost out on those 20 points there, we put a pending, because I always say once you're in one trade, you delete your other pending orders. But now that we've lost out on this buy trade, you can now go back and place another pending order just below the first support. But at that time, we didn't place another pending order. We're just waiting to see what happens in the market. Because at that time, you're not sure, because the market had fallen, broken the moving average 50. So you're not sure if this is going to be a downtrending market, if it's going to be going sideways or not. So it's best to wait and see. So we placed a pending sell order just below the first support, but didn't place a pending buy order. Now at this point in time, which I sent you all out an email on the blog, at this point in time where the market had now descended even further, because at this time the market has formed a low, a high, a low, a high, and then a low again. So it's forming lower lows and lower highs. So you can now see it's now downtrending. It's now below the moving average 50. So obviously if it's going to keep going down, it shouldn't go back up, because if it's going to keep downtrending, it will keep going down. And you can see the previous high, the pivot point was above that. So at that point, you can now place a pending buy order just above the pivot point, knowing that, you know, if the market keeps going down like it should do, it won't come to your buy order. But if it turns, breaks the moving average 50 again and breaks this previous high, you'll be happy to buy just above the pivot point. So it was at that point we now placed the pending buy order just above the pivot point, and we left the pending sell order just below the first support. And then the market went down, and as you can see, it took our sell order, took our pending sell order, and then went straight back up, and then took us out with a loss of 20 points again. So this was our second consecutive loss. Our first loss was the buy order, the second loss was the sell. So we're now down to our last trade. And then looking at the market, again, it's still fine to put our pending order to buy just above the pivot point, and the pending sell order just below the first support again. But we're now down to our last trade. So if the market takes the sell order, then we'll delete that buy order, and this will be our last trade. If it goes up, takes the buy order, we'll delete the sell order, and that will be our last trade. So that's where we are. That's where we are now. So if you have any questions, do click the hand button or send it through the question box. Hi, Kemi.
Hi, afternoon, Remy.
Hi.
Just a quick question. I mean, you may have already mentioned it because I've just joined, so you may have been talking about it. Now, you spoke about putting an order at the first support. Now, the low, though, was at 14,754.7. That's the low that it made. Now, what I was thinking was seeing whether or not it hit that support again and then went back up, and then I would then place my order thereafter. I wouldn't necessarily place it now, so I was just questioning why you're putting your order there now without necessarily testing to see whether or not this is going to be a support. Am I making sense there or not?
Yes, actually, yes, you're making good sense, and actually that's a very good point you raised, and actually that's, I'm happy you raised that point, because it always goes to show with trading, I always have to say you are your own boss, and that's a very valid point you made, and that's something you can go with. Because I always say with trading, there's no right or wrong answer, so long as there's some logic behind what you're doing, then you go for it. Because I think the key things are, one, you've got 3 attempts at the market, like I always say. So you decide how you use those attempts. So you are perfectly right. So if you say, it's just a bit like how I place one cautious trade prior to a report of high importance. I always say if you don't want to, you don't have to. You can just keep out of the market. So what you've said is actually a very good alternative. I mean, for everyone else, what Kemi is saying is that you can see the market broke the first support and formed a low there of 14,754, and then went straight back up. So you can put a line there of 14,754. And what she's saying is that what she will rather do is wait and see if that gets tested and then goes back up before she then places a sell order just below that, and that's a very good option. So you can do that. So I wouldn't say that's another good alternatives. So they always, and that, there is a lot of logic in that. So that's perfectly fine to do. So you can say, you place a line there, see what happens, the market gets there. Alternatively, which is the one I'm going with, is that the market has reached there, it's broken it once. Obviously it could then get back to the first support and break it again and just keep going down. I mean, the only person that knows what's going to happen is the good Lord, like I said. So that's why I would say there's no right or wrong answer. So the market could get here, break the first support again, and just keep going all the way down, and you make 60 points. And then I make some money. Or it could come back to here, break it, take my order, go back up, and I lose 20 points. And you wouldn't have lost any money, and you'd have waited to see. But what is going to happen, nobody knows. You see what I mean, Kemi?
Yeah, I think the only reason why I'm tempted to do that is obviously I placed a sell order there, so I already lost, the first trade, and I've made a decision that I'm never going to add money to my account, so I'm a bit more cautious than I used to be.
Which is good. I always say it's always good to be, if in doubt, go with the more cautious approach. If in doubt, go, because. But I think what I'm trying to say is that it's trying to go with your conviction and always say to yourself, even if the market comes, breaks this and drops, 100 points, you don't worry, because if that's what you want to do, you stick with it. Because there's always pros and cons to anything. But I think the key is to make a decision, and like say your decision to do that, it's a good one. And there's a logic, and that's the key. And always, it's not a question of focusing on how much you make or lose, so long as, you make a logical decision, and that's a good decision to make. That's a good one.
Okay.
But I think sometimes on the flip side, people worry about, or you can get upset that, if the market goes there and then keeps falling and you lose out, you might think, oh, done, and then next time you don't want to be cautious. I think that's what you need to guard against. So it's, I think, yeah, what it boils down to is making a decision and then stick with it, and, what will be will be. But I think so long as it, yeah, go ahead.
Oh, no, sorry, finish your point. I've just got a different question. Sorry.
Oh, yeah, I was just going to say, so long as your decision makes sense and it's a logical decision, that's the key. So if your decision, whatever decision you make in trading, if it makes sense and it's a logical, practical decision, that's the right answer.
Okay.
So I always say, there's no right or wrong answer. The wrong answer is if you just place a trade and there's no logic to it whatsoever. Then that's just gambling and you're just taking a pot shot at the market. So say, for instance, now you just say, oh, the market is going up, I'll just buy here at this point. And it's like, why are you buying here? There's no rationale to be buying at this point. So say, for instance, you said you want to buy, let me put a line there. You said to yourself you want to buy here at that point. Because you see the market is going up, you just want to buy here. Then now if you're buying here, what's the rationale here? There's no rationale. There's no indicator here. The market has not made any, there's no point of reference here in the market. So here is just gambling. So there's no logic to it here. Alternatively, if you said you want to sell here, at this low here, so if you say you want to sell here, again, there's no logic to it, because there's a point in the market that's lower than that. So why are you selling there? It's above the first support, so why are you selling there? So again, that doesn't make sense. So I always say, so long as whatever decision you make makes sense and it's logical, and that's fine. So you just always go back to say, okay, you've got 3 attempts at the market. How do you use your attempts? Think carefully before you use them. But the second time to, okay, the second point is to say don't, because the two things that hamper you as a trader is fear and greed. Greed, obviously, we know about, that's over trading and not applying good money management and trading too much. But the other thing too is fear that you want to guard against, because fear too can freeze you and stop you from trading. So again, I guess that's where trading small sizes helps. So at least you don't risk too much money. But again, trying to guard against fear is just to have a plan your trade, and then once you're comfortable with your decision, just go for it, because you don't want to freeze and not trade and be fearful. So that's the thing you have to do is decide, look at the market, look at the chart, look at the circumstances, pick your points to enter the market, and once you're happy, just go for it. And then if you have 3 consecutive losses, that's fine. But so long as each trade were well thought out and according to your trading plan. Okay, second question, Kemi.
Okay, in terms of the market, would you say that it's trending sideways when you look at it from 12 o'clock to where we are now, so 12 midnight to where we are now? Would you say that's a sideways trend or not necessarily?
Yeah, it's beginning to look like it. I mean, let's follow it. Let's follow it closely. That's another good question, because the market is dynamic. So let's follow it. So we can see, let me use this one move. So let's start from midnight. Yep. The market has gone there, it's made a low. Yep.
Yeah.
And then made a high there. Yep.
Yeah.
And it's come back down here, it's made a low. So it's made a new low. Let's move that there. It's gone up there, it's made a high. And then it's come down here and it's made another low. And that's like, you know, testing that previous low. So you can see it's formed the support in the market there. Someone was asking in the Stock Trading for You forum about double bottom. So that's just like a double bottom. You see the market formed, it fell, made a low, went up, came back down to that same point, made a low. It didn't break that low and then went back up. So that's a support in the market. You can say that's a double bottom. Then it's gone up, it's broken that high, formed a new high there. And then it's come down and it's broken that and it's now formed a new low. So now that it's formed a new low, we're expecting it to keep going down if it's a market that is falling, isn't it?
Yeah.
But instead of forming a new low, it's gone up and formed a new high. Okay, so that's fine. So at that point where you thought it was going to go down, it starts going up, it forms a new high. So we expect it to keep going up to form a new high if it's going to go up. So it formed the high there, it went down here, formed the low. So we'll now move with the market. It's formed the low there. And it's gone sideways. And it's come back down, it's formed a new low there. And then it's gone up, broken that high. It's formed a new high. So at that point in time, we think it's going to start going up. So it's formed a high. It's come down here, it's formed a low. But at this point, we expect it to go back up, yep, and form a new high, isn't that right?
Yeah.
But no, it doesn't. It just forms a high here, which is lower than that. And then it goes back down and forms a new low. So it's formed a lower low, so we'll move that to the new low. It's gone up, formed a high. So that's lower low, and then it's a lower high here, yep. So we'll move that to the new high. It's come back down, it's formed a new low. It's another new low, so that goes down to that new low. And then it's gone up, made a high, so that's another lower high. So far it's making lower lows, lower highs, isn't that right? So it's trending down nicely. So now it's come down, it's formed a new low, so it's broken that low, it's formed a new low, so that's another new low, so that's another lower low. And that's where we come to the 14,754. And if it keeps going down, we don't expect it to break that high, but it does. It's broken that high, and it's formed a new high. So the high there now is 14,811.4. Let's check, that's 14,811.5. So let's just say 14,812. 14,812. Oops. Let's make it accurate. Okay. So you can see now at this point in time, that's the most recent low in the market, yeah? And that's the most recent high in the market.
Yeah.
Yep. So now, from here to here, there is no pattern to the market now. Because it's not making, you know, lower lows and lower highs or higher highs and higher lows. Because you can see here it went up, made a high, then made a low, then made a high, then made a low, made a high, but when it came back down, it came back up and broke that high. So it's really not, it's not the uptrending patterns. There's no downtrend pattern. Yep.
Yeah.
But that's the most recent high, and that's the most recent low. So it's from this point now we look like the market is going sideways. Actually, it's a good thing you asked that question, because sometimes, obviously, with time and experience, you can easily just visualize the market and tell quickly where the highs and lows of the trend is and where the sideways trend is starting from. But just like you said, and that's a good question, because sometimes if you're not sure, it's good to follow the market, because always remember the market is dynamic. So if you're not sure, it's good to just follow the pattern of the market to the present time, and then you'll be able to get a good idea. Because like you said, if you're looking at, even if you look at it from yesterday, when the market was falling, you can see there was a period here where it went sideways, then started to fall again. So yeah, sometimes it's good to follow the market like that, because the market is dynamic. The patterns change, the patterns evolve. It can go from trending to sideways, from sideways to trending, from uptrending to downtrending. So you need to know when one pattern changes from one to another. And yes, like I said, with time and experience of looking at charts, you'll be able to tell straight away. But yes, it's also good to be able to follow it systematically and then determine accurately when the market has stopped trending, when a sideways trend starts. So actually, with that in mind, like I said, that's why I said what you said there before was a good thing if you want to do it. Let's say, for instance, the reason why I was happy to sell again just below the first support is because, where the market took the order and went back up is more or less at the exact point where we entered before. So I'm happy to take that risk again. If it comes back there, I'll sell. If the market, on the other hand, actually, it's a bit like what we did here in the morning. That's a good example. In the morning I said if the market takes the buy order and it takes us out, we won't place a pending buy order just at the pivot point straight away. You remember that? Kemi?
Yeah, can you hear me?
Yes, I can. So you remember I said that this morning, that if it takes us out the buy order, we won't place a buy order there straight away.
Yeah.
Yeah. So it's because the market has gone past the pivot point. So if we lose out, I will just not place a pending buy there straight away at the same point. Just for the same reason you were saying there, because it's slightly different here because the market has gone way past the pivot point.
Yeah.
And then if it takes us out, yes, I'll be reluctant just to go straight back to that point. But the only reason why I now placed the buy order at the pivot point is because the market started to trend down, forming lower lows and lower highs.
Yeah.
And then that's...
Yeah, no, I understand that one. I think that one's quite straightforward, actually, that one.
Yeah. Yeah, but I think it still follows your premise, because what you said is quite important, because at that point there, if the market had taken us out there, around here, let's just say for academic purposes, it took us out here. Yes,
I can't
you're right.
see where's your cursor? Oh, there.
Yeah, at the end here.
Yeah.
So if this is what we're seeing at that time, and that's why I was warning everyone before we logged off, that if it took us out like that, don't go straight back and place a buy order there straight away. Because, it's already taken us out, gone past the pivot point, taken us out. So don't be quick to put a buy order there.
Well, it's quite interesting, actually, because I actually didn't place that order this morning anyway. My logic was that because when you looked at the 1 year daily chart, it's gone past the the Fibonacci retracement, and it seemed to be uptrending.
Yeah.
And so obviously, so I looked at this one first, and then I went to the 2 year. Sorry, the 2-day one.
You say it was uptrending, so were you...
Yes, it is. Yes, it is, isn't it?
So if it was uptrend, what were you
No, I beg
reluctant
your
to
pardon.
buy?
The 1 year chart is uptrending.
Yes.
Yeah, and so but when you looked at the the 2-day one, it
Yeah.
seemed to have been downtrending, and for me it
Yeah.
just looked a little bit unsure as to what it was going to do. So I thought to myself that I would actually wait, to see what it did after the pivot point, and then what I had thought I might do was, if it then went past the pivot point, then I would place an order, afterwards. But it didn't necessarily give me an opportunity to do that.
Okay. Again, that's not a bad point, but I think you have to. I think with any trading plan you do, if that's what you do on a regular basis, then that's fine. Because you find that with most plans, it all evens out. Like I said before, you won't get any plan that will give you 100% success rate. Because, like you rightly said, because if you still follow the logic of what you said, it's an extremely bullish market. Yeah.
Yeah.
And the market is going up strongly. And this could have just been a pullback, and then the market could have taken off today. And, that could have been just a pullback you were seeing, and then it could have broken the pivot point and just raced off.
Yeah, that's true. I suppose you don't know really, do you?
Exactly, that's the key. And I think that's what I'm trying to highlight, is that obviously trading in hindsight is 20/20 vision. You can't, unfortunately, we can't trade in hindsight. So there's no way of telling. But I think what you need to make sure is that, whatever you do with your trading plan, you need to do on a consistent basis. So if you're going to keep waiting for the market to test your entry points first before you use them, you could find you could be left behind on quite a few trades.
Well, you see, I wouldn't necessarily do it all the time. I think that I do it, and I do it where the market for me just looks a bit unsure. So especially when you look at the 1 year chart, and if the
When you say it looks
2-day,
unsure, it actually.
I think it does, because the 1 year, like you said, is bullish,
Yeah.
but the 2-day is going in the opposite direction.
No, like I said, but just remember the market is not going to go up and down a straight line.
No, yes, that's true.
So the market won't just be going up and up. I mean, you can see from the although it's extremely bullish, we can see red bars on the days it's been pulling back.
Yeah.
Yeah, I mean, actually, this is a good example here. You can see this order I have here. Yeah? That's the swing trade I have here. Because you can see
Are you in the swing trade?
Yes, you can see that 523 points.
Wow.
Now, see, this is another example of what I'm telling you. That's why you have to be careful that you just have a plan and stick to it. Because you have to be careful you do what you do on a regular basis without fear. Now, you can see here I bought this swing trade here. Yep. It went up 100 points. Yep.
No, sorry, Remy. Where did you buy it? At the 23%?
Yes, 23.6.
Yeah. Okay. Yeah.
Now I'm just going to show you. I initially bought. It went up 100 points. Yeah.
Yeah.
And I moved my stop to the opening level.
Yeah.
Yep. But you can see it came back down and took me out. It took me out, and then it obviously was still above the moving average 50. And then it started to go back up again. So when it started going back up again, I bought that following day using, obviously, the day trading technique, and I just stayed in that market then. So that was my entry point. So it's a bit like you were saying today. So this day here, the market, you can see the huge fall. But that didn't stop me buying on the following day.
No, but the difference was, though, is that you'd moved your order to your opening level, so you didn't lose it out anyway, did you?
No, I'm saying that the thing is I took the trade. I didn't wait.
Okay, yes, I see. Yeah. Yeah.
You know, that's what I'm trying to say, because you were saying it looks funny, it's going down. So yes, it fell. The market was bullish. It fell that day. I'm just saying that, you know, it's a question of, again, remember there's no right or wrong answer. But I'm just saying that with my indicators and my trade, I don't think twice about it. So on that, the previous day, yes, it fell. But the following day, just like we saw today, was going up. I placed my trade and took the trade. You know what? That's what I'm saying. So I didn't hesitate about taking that trade. Again, I always say it's not going to be right all the time, but I think the key is to, because I think what you don't want to do as a trader is be hesitant. Because, I mean, I don't know if you remember the trades we took last week, the successful trades we took on 2 consecutive days.
Yeah.
Yeah, I mean, if you were hesitant on those 2 days, you would have missed those trades. So that's what I say.
Yeah, I think, though, it's just about getting the balance right in terms of your money management.
The money management is the key, because you want to make sure when you risk, I think it's going back to what we said, that no matter what you do, you're going to lose out 6 out of 10 times. No matter what you do and how careful you are, anytime you pull the trigger, you have a 60% chance of losing money, regardless of what you do. So that's why, yeah, you're right. So when you actually then place a trade, because you know there's a high risk of losing money, make sure you trade according to your trading size. So if you've got a small capital, then you make sure your trading size is very small. So yeah, that's the key. But the overriding message is that yes, regardless of what you do, you are going to have losing trades. So you can't avoid that. When do we start the trading? Let me see. Get to the calendar.
28th.
28th, okay. Is it 28th?
No, it wasn't.
Oh no, 25th. It's the 25th. The public holiday. Let's see, 25th. Let's go back. What date is this? This is the 26th. Okay, this is a good example. Let's look at that. So you can see here, this was the trade we took on the 26th. Monday, the 25th, was a public holiday, so we didn't place any trades. But you can see here, can you see this chart, Kemi?
Yeah, yeah.
Actually, you can see this is exactly like today. You can see the market going down sideways and going down and sideways. Isn't that right?
Mm-hmm.
Just like today. But you can see we placed our buy order there. You can see how the market just took our trade and took off. And then that was the trade. So we, where is it? Oh, come back down. So that was the 26th. So the market took our order, went up. And you can see here on the next time, before you knew it, you can see it didn't even pull back. Yeah, can you see that?
Mm-hmm.
You can see it took it and went straight up and went halfway to our 30 points. So if you were waiting for it to test it there, you would have missed out. So you can see that. I said that's a good example. So you can see it took off, no pulling back. By the time it pulled back, you know, it left you behind. And then we achieved our profit target of 60 points on that day, on the first trade, and we were done. So you can imagine if you had waited, you would have missed out on that trade. So that's it. You can see that here. And again, it was the same as exactly what we're saying today. You know, the Euro-US dollar was bullish, but the market was falling. It was going sideways. But again, actually, this is a very good example. So it's because, so if you had used your logic today, again, I'm not saying it's wrong, but it's just something you have to do on a consistent basis.
But you see, Remy, for this day, what I would have done here, obviously because the market at the first support is trending sideways, I would have put a line across, and I would have bought, not at the pivot point, but I would have bought at the previous high, and it would have been, you know, I'd have put a line across, you know, maybe from the 3 o'clock point.
Yeah, but I hope you're getting the point I'm making. The point I'm making is, you know, is to have a plan.
Yes.
Stick to the plan, and then pull the trigger. And the key is that no matter what you do, you are still going to lose some money and lose some trades. You will win some and lose some. That's the key. So I think that's what I'm trying to, you know, emphasize, is that, you know, there's no method that you will, and no matter what you do, you're still going to lose some trades. But the key is that if that's the way you trade, and that's the plan you have, and that's what you do consistently, then just keep doing it. And if the strategy you trade, if that presents itself, and you say, okay, these are the points I use, and if this situation happens, this is what I'm going to do, and that situation happens, then go for it. So that's what I'm saying. But the key is to, when you go for it, remember that you're not going to get it right all the time. And the most important thing is make sure that once you've done your analysis and your entry points or your strategy presents itself, just pull the trigger, bearing in mind that there's a 60% chance you could lose money on that trade regardless of what you've done. So in that sense, you will make sure you only trade a small contract size, or you trade according to your capital. So I think that's what I'm trying to get at. Because you'll find, you know, you win some, you lose some. You know, there's no trade that, there's no strategy you use that's going to give you a 100% success rate. I think that's the key. I think that's what I always try and overemphasize to people, because there's always a danger of trying to fine-tune your trading to make you get it right all the time, or to avoid losing. And you will either get to a point whereby you will then be too scared to trade because you're scared of losing, or you're trying to look for the holy grail that will make you have a successful trade all the time, and you will not pull the trigger. So I think that's the key.
Yeah, yeah. If you had 3 consecutive losses,
yes,
every single day, you wouldn't have any money in your account.
But in fact, that is why we do this 2 weeks trading session, to show you that if you trade well, that doesn't happen. It's possible, but it's extremely unlikely if you follow a trading plan. And I think it actually goes to what we're just saying now about making sure that the key is not changing your plan every day. Because just like we're saying, if you have a plan and that's the way you trade on a regular basis, and that's your plan, then stick to it. Like it's the key. So the key is not whether you're using my plan or whether you're using your plan. That's not the key. The key is have a plan and then be consistent with that plan. And I think that's what makes you successful. Not have a plan, then because, I mean, today is a good example. You know, I wouldn't say because I lost money today, I'm going to abandon my plan tomorrow. Because if I did, I could have missed out on the trade last week, like I showed you. So the key is just to stick to my plan and to stick to what I do. I'm not saying what I do is the best, but what I do is successful for me. So if you decide you decide you want to trade a certain way, then the key is to stick to that certain way you trade and be consistent. And as you've seen, you know, we we traded last week and we ended up with £140. So we still have enough money to trade this week, which is actually the first goal of money management, is to survive to trade the next day. And we've got 140. So even if we have 3 consecutive losses today, we'll be down to 110. But we'll see what happens. And we still have money to trade, and we'll just keep going with our plan. So yeah, I think, and that's another major reason why I do this 2 weeks trading session, just to show that if you apply a plan, if you're disciplined, apply good money management, and stick to your plan, then yes, it's very, very unlikely you will wipe out your account. But yes, if you do, if fear comes in, if greed comes in, if you're not consistent with your plan, then yes, there's a possibility that, or it's a bit like, a good example is like you over-trading on a public holiday when you know that the market tends to trend sideways, then yes, you could wipe out your account. So you can imagine going from trading all day on a public holiday, then you wipe out your, then the following day you start trading again, over-trading before a report of high importance comes out. So yeah, if you keep just breaking the rules, or then maybe one day, because you've lost a lot of money, you fold your arms, you're scared to take a trade, and then that trade becomes a successful trade, but you missed out because you were scared to take it. So it's all the sort of things that you find can hamper people's trading. There's all these sorts of things that, yes, will make, problems occur and make you not successful. So I think, in fact, again, I always say that that's why we do it for 2 weeks, because, I think, you've been lucky to do all the 2-week sessions with us, Kemi, over the last, 2 or 3 years. Isn't that right, Kemi?
Yeah.
Have we ever wiped out £100?
Never.
Exactly.
I laugh because it's just when you start trading by yourself is when you wipe out your whole. That's why I've decided that money management is the key, and I'm getting much more disciplined, in terms of not wiping out your capital, which is why I said that what I tend to do now, I only trade with the money that I've got in my account, so I never add money to my account.
Yeah, and also, like I said, the thing is also making sure that you have a plan and stick to that plan.
Yeah.
That's the other key, because you want to make sure that you don't, because that's, like I said, that's another thing that can happen with some traders is, they do have a good plan, but the question is, are they executing that plan, or is emotion getting in the way when they start getting either fearful or greedy? So we've had 2 consecutive losses so far. We'll see what happens, whether the market takes our third and final trade or not. Okay. But those are very good questions, Kemi. It's actually very good questions to use for discussion, because actually those are the sort of subtle points that actually make the huge difference in trading. Because you find that, and that's why I say, if people should ask as many questions as possible, because you find that, the strategy of trading itself is straightforward. Buy here at the pivot point, sell at the support, understanding what pivot points are, moving average are, that's all, it's easy to understand, but how to apply it in practice, in conjunction to the market, knowing when to use it, when not to use it, money management, discipline, is all those sorts of things that actually make the huge difference between being successful and not. Thanks, Kemi.
No problem. Thanks a lot. Cheers.
Any more questions before we close for lunch? The other thing I'll just highlight before we go is, again, the importance of stop losses. The huge importance of stop losses, because, again, that's another problem people have. They will say, oh, I want to give the market enough room. they forget you're day trading, you're not swing trading. Yes, with swing trading, I use a stop loss of 100 points. So when I swing trade, I use a stop loss of 100 points to give the market enough room to move, but not for day trading. So you can see here where the market took our order. You can see that, even if you had 40, 50, 60 point stop loss, the market would have still taken you out. So it would have taken you out. You can see the difference between here and here is actually 76 points, and I calculated that. So you could have ended up losing up to 76 points on that trade instead of just the 20 points. So again, that's why I stick with my 20 points, because sometimes you find the market, again, can trick you. The market can come down, take you out, and go straight back up. And you think, gosh, I need to move it to 25 points. It will come back, take your 25 points, and go up. Then you say, oh, I need to move it to 30 points. 30. When do you stop? So again, like I was saying earlier, this is the key to trading, is have a plan, be consistent. And like I said before, make comments on your chart, make comments on your trades. And then you can then reflect after a couple of weeks or a couple of months and then make objective decisions, not emotional or reactive decisions. Make objective decisions. Because the reason why I use 20 points is because I've observed over a long time that, initially when I was using 10 points, yes, I found that was too small. When I started using 30 points, I found that was too much. When I started using 20 points, I found that was sufficient. And so it's not from guessing. It's because I came up with 20 points and 60 points limits after months and months of observing, using different points. And I found 20 points to be sufficient. But again, you can make your own observations. But I think the key, again, is to make sure you make objective decisions and not emotional decisions, and then you stick to your plan. So you can see, regardless of what the market does, I don't care what the market does, I'm only going to risk 20 points. If it comes here, takes me out and just for 21 points and goes up, that's fine. I lose my 20 points because I know I'd rather just lose 20 points than 30, 40, 50, 60 on one trade. And again, same here again, you can see it took the stop, took our order, and went up by 56 points. So again, even if you had used a 30-point stop loss, 40 or even 50-point stop loss, you would have still been taken out. So again, it's trying to limit your losses. So you can see we've had 2 consecutive losses and we've only lost in total of 40 points. Whereas if the person here who had been messing around could have used a stop loss of 50 points each, and they would have lost 100 points on just 2 trades. Whereas we've just lost 40 points. So again, that's what it's called limiting your losses. We're not sure what we're going to make, but at least we have complete control on what we're going to lose. So that's another point I just wanted to highlight, because some people have that habit. I'm not saying, again, I keep reminding people, I'm not saying my plan is the best or my plan is the only plan. I'm just saying that I've devised my plan after watching the market from an objective point of view and making objective decisions from years of observing the market. So I'm just saying that if you're going to make any plan or you're going to change anything to your plan, make sure it's an objective decision you're making from observing the market over a couple of weeks, even better over a couple of months. And then you reflect and make an objective decision. Because as you can see, the market is crazy. It's all over the place. You don't know if it's going up, you don't know if it's going down, you don't know when it's going to go up, you don't know when it's going to go down. It's all over the place. Reports can change it. All sorts can happen in the market. They always say the market is illogical. So for you to maintain order in the chaotic market is your trading plan that helps you do that. The market is completely unpredictable. Anything can happen. You know, we could just find out all of a sudden now that Osama bin Laden is not dead and he's alive, and that could just shake the market. And, you know, so anything could happen. And that's the beauty of the market. Anything can happen at any time. But what keeps you out of trouble is having your plan, knowing exactly when you're going to enter and exit the market, and most importantly of all, your stop losses. Because you know, regardless of, so yes, if Obama or David Cameron all of a sudden announces something crazy or something crazy happens in the market, at least I'm protected with my stop loss. So I know that regardless of what happens, I'm only going to lose 20 points. Okay. Any questions before we end the day? Okay. Good. No questions. I'll just quickly recap before we finish that, you know, yes, we've had one loss. First trade, we lost 20 points. Second trade, we lost 20 points. We're now down to our last trade for the day. So I've got a pending order to buy just above the pivot point if the market goes up, the pending order to sell just below the first support if it goes down. And if it keeps going sideways all day, then by 8 o'clock, I'll just delete the orders. Obviously, if it takes one, if it takes the sell order, I'll delete the buy order. If it takes the buy order, I'll delete the sell order and only concentrate on that last final trade. And if that final live trade ends up being a losing trade, that's just the end of the day. If it's still successful, that still is the end of the day. So that would be, this would be the last trade no matter what. Okay.